You're listening to Burn Rate and Bullshit.
The show where founders, suits, and corporate clowns all get called the fuck out.
We're Josh Robinson and Mike Nathan, entrepreneurs turned VCs.
With zero filters, strong opinions, and a bullshit detector set to high. Welcome to the only business podcast that actually tells it like it is.
I'm a desperate man. Send lawyers, guns, and money. This shit has hit the fan.
Founders love saying, we're all owners here, right up until someone asks how much of the pie they actually get. Half the time, the cap table's a mess, and the option pool is a black box, and early hires are basically gambling their careers on vibes and a percentage that sounds big until you see the fully diluted math. Today, we're tearing the lid off fantasy and talking about what fair equity really looks like for founders and for the first 10 people through the door.
Let's be blunt. A lot of ownership in startups is theater. Underwater options, tiny grants, insane dilution once real money shows up, and somehow everyone acts like this is just a game. Meanwhile, founders either get bullied out of control, become equity hoarders who can't hire killers because they won't share. If you're going to trade your time or company for slices of stock, you'd better know exactly what you're selling and what you're getting. So Josh,
Yes, Mike?
employee equity, shares, stocks, units, however you view them, nice to have, right?
It's great. Founders that recognize the value of equity stakes for the first handful of employees, good on you. In fact, I've not heard of an example of where people aren't doing it. I think it's just almost commonplace now. And the question is just the variability around it. Are they getting 5% and the employee pool is at 10%, is it 20%? The founders that are doing that, I think it's fantastic. The secret, the dirty secret about it, maybe the dark side of this is people assume oftentimes that it's going to be this massive payout for the employees at the end of it. And it can be, and sometimes it is. The reality, though, is more often than not, you end up getting diluted down to nothing or very little once people like us show up with professional money from the VC, and they just don't get what they think they are going to get. I don't think that takes away from people should do it. There's real value there. I just hear founders and early employees often talk like they won the lottery, and too often I just see it at the end of this. The other end of the train station, they don't get as much.
Yeah.
Or we're going to. And so it's setting. I want to talk through that a little bit more in this episode to touch on the reality of what that looks like. But bottom line, I think it's great. I mean, what's been your experience with equity?
My experience is, here's what something you said always makes me think, and this is always the conversation as an early startup. You're bringing folks in. Co-founders or the founder owns 100% of it, likely right away.
Yep.
Raises money, or the co-founders own all of it. And I think what we're talking about, or what you're talking about specifically, is somebody after the co-founders, after maybe the first 5 hires. This is when the risk is farther along the path of it's actually not that risky. It's risky, but it's not crazy. So the kind of the founding shares or equity you give out to the people who were there when you were forming the company looks different. You're going to get 5, 10 if you're really generous, right? If there's more, you give away for the value they created, their input that they did. I think what we're talking about are the sort of the average everyday worker bees who contribute to the value of the company, but not in the same way those early folks did. And those percentages should be viewed as, so if you're employee number 10 out of 12, you shouldn't be thinking I'm getting 10% of the company. You should be thinking I'm getting 0.5%.
And at that particular moment.
And
it's going to be diluted further down from there.
That's right. But here's where I'm thinking. For those folks, you need to be thinking, this is a perk, this is advantage, this is a really nice part of your job, but it's not the only reason. You're likely getting paid market rate for your job, or maybe even above, to be a part of a startup. And you get the benefit and the bonus, if you will, of that equity stake. When you're employee number 2, way riskier, and so you likely get compensated with equity to offset the risk that you would associate and not
Or
have
the
a
low
lo-
cash. They just don't have the cash to
don't
pay
have the
you.
cash to pay you. So they're going to get something different than you. So if you are not in part of that, again, that founding, even though you're not a founder, it's kind of that founding group of people, don't expect it to be worth millions. And that's not likely why you take the job. It's a bonus. It shouldn't be sweet. Now I get to retire because to your point, it likely ends up.
Not going to be a windfall.
No, it's not going to be a windfall. I mean,
And it's not going to be in a lump sum either. It's probably going to be over several years and payouts. It's not going to be this massive single check yet.
and so, and don't confuse it either, because I think I'd like to hear your story. Some people don't view it as even a benefit or a perk. Offered to people, you would think, of course, everyone's going to take equity in a company. And most of the time it's, it's some sort of LLC or an S Corp, or you have protections as an owner. And when you grant and or put out options for folks, do they always want it, Josh? Do they always want equity in a company?
Even hearing you ask that question out loud, it's mind blowing to me that anyone would turn down equity in the company that they're in. And it hasn't happened a lot of times in my career. It's happened though, where we've tried to give everyone in the entire organization equity. And we had more than one person say, I'm good. Thanks, but no thanks. I don't even think they thanked us. I think they just told us to pound
And there
sand.
wasn't an alternative like, hey, take the equity or we'll give you cash. It was not.
No, it was just, no, we don't want
Here's
it.
equity.
And trying to walk through, and these were not frontline people. I mean, they were mid-level and senior in terms of their career. They understood how the world worked, we thought. And we weren't taking away any cash compensation. We weren't reducing their base.
Purely additive.
It wasn't in lieu of another cash. It was 100% just net new because we think this is the right thing to do as the management team. And people said, no, I don't feel comfortable taking the risk of owning the company.
Didn't somebody tell you that they were advised to not take it?
One person said that. Like, well, who the fuck is advising
Who are you
you?
talking to? Yeah.
I mean, your brother's cousin's sister, boyfriend that works in a strip mall as an ambulance chaser attorney. Like, is that who's telling you not to take it? Like, who the hell's telling you not to take equity?
In fact, as you know, you live this. I say it and live it. Ownership is greater than earning. You won't get ahead by just earning. Not likely. The percentages will be against you. Inflation will be against you, etc. You need to own stuff. And you don't always need to start your own company to do that. You can take equity in the company that you're with. Otherwise, you are going to financially fall behind. So anybody advising you, no, don't take that equity, is an idiot. And I'm making the assumption there's no liability risk, which is not the case in most of the situations we're talking about. You are protected.
You may have some kind of tax impact, but that's not
from making money.
That's
a thing.
Whether it's realized or unrealized gain, right? There's going to be some kind of tax thing there. But from a true risk legal liability perspective, assuming the company's structured it the appropriate way, meaning it's an LLC or a C Corp, there is no legal risk to you as an owner. That's why you set things up that way.
And I know some of the people that you're talking about in this example, and it wasn't about, I hate the company.
No.
It wasn't about,
I mean, they chose to work there, right?
They chose to, and they continued to work year after.
Yeah, it was a while after that.
After we even offered it. And I, honest to God, think that they have a misperception of ownership. Period.
Well, I was hoping we'd go there because you've mentioned this a little bit in the past of one of the number one things that all MBA schools should focus on is cap tabling because no one understands cap table math, structure, how it all works. And I agree with you. I think part of those people's in particular's issue, and even more broadly why people don't understand exactly how employee equity works, is no one understands how cap tables work in a startup.
Nobody.
Not a single person.
Our attorneys usually don't, kind of. CPAs are better at it, but they don't understand the nuance to some of it. But they'd be your best source of truth, likely. But likely what their source of the truth is, that's not what I intended. I wanted to do this.
Yeah, right.
Never mind. Well, we got to rewrite everything. Um, well,
So do you have to do an education as you hand out equity? To
I think
employees?
I think it's two parts, not just in cap table, because there is a very nuanced, and that's more of a, that would be on us then to educate them along on what cap table looks like. I think it's a bigger issue. It's around entrepreneurism. It's around early startups. Even though people kind of think it's sexy, people in the United States, entrepreneurs and most great executives are stuck because of fear. And it's this idea of risk. People don't understand what actual risk is, how to calculate it, how to think, is it worth it? Or just avoid, like, there's going to be risk in everything you do. The fact that I decided to walk across from the hotel to come on over here, there was risk in that. I could have been hit. There's a risk that these coffee cups weren't washed properly, and I'm going to have a little bit of a gastro issue later. There's risk in that. I'm still going to drink from it. So I'm assuming you did the dishes. And so when we talk about, hey, would you
Great
like
visual, thanks. Man.
Yeah. Hey, I don't know. Are you interested in free fucking money? No. That seems risky. Like, how are you viewing the world? How are you viewing the world? And I think it's more fundamental than that. I think people just think they're being smart by playing it super safe. And what I'm telling you, I think what you believe is owning is greater than earning. And if you fuck around and just think you're going to W-2 your way to an amazing retirement, I think you're mistaken. You need to own stocks. You need to own real estate. You need to own parts of small companies. You don't always have to be the founder, but you better own some motherfucking assets other than your paycheck. So people don't even, and then the fact that they can't even assess free money and they view that as a risk, that's silly. That's not me walking them through. They already have that mindset. So in today's day and age, you better understand how you get ahead, and it's through ownership. It's not earning. But so they fundamentally, and too many people, and although they didn't turn it down, how many in that same group that we're thinking about had to think about it? They wanted to talk to somebody.
Yeah.
They weren't like, I'm like, awesome, this is great.
Do you think part of that in that example is the geography? So we were largely based in the upper Midwest. It is not as common here that there's startups.
And it was healthcare.
It's healthcare. You know, if you were to go into more of a tech type company on one of the coasts,
Maybe.
do people just have kind of that domain knowledge around what
It could be a
that
little
looks
bit
like?
of Midwestern, shucks.
You think so?
Maybe. Could be a little bit with healthcare. People, there's a dirty word, profitability in a healthcare company. That's, we have to call it sustainability, not profitability in healthcare. Whenever, not all docs or providers and people in healthcare get nervous around profits, but a lot of them do. I'm supposed to be making no margin in healthcare. I shouldn't be making any money. I should be doing this for free. In fact, you should be volunteering your time.
I should be paying you.
It's the dumbest damn thing I've ever seen. No, it's not. Your business, like anything else, it's okay to make money. In fact, it's encouraged, even in some areas. So I have found, and so I don't think it's necessarily Midwest. I don't think it's necessarily healthcare, but I think they both contribute. And people just don't understand risk. I view it as a founder of a couple of companies, particularly in healthcare. There was a company that I started back in the day that did mobile urgent care. And we had 30 people on the cap table when we sold to a large payer, insurance company. And of the 30 people on that cap table, 15 were employees. Some of them did very well. The people that were early and the people that were still there at the end and contributed the whole time, they did very well. Even the last person did just fine. Nobody was likely going to retire from some of that money, but it was certainly probably was a year of tuition. It was the summer cabin. It was something significant that it was worth their time, the risk, all the things.
Right.
In the last company we've been a part of, we had 40-ish people on a cap table, healthcare, alternative care delivery. And we had another, out of 40 people on the cap table, we had 15. So maybe call it a third, half and a third. And I think that's good. That's good practice as a CEO, as a startup founder. That is a really good practice. Outside the founders, a really good way to get employee engagement or get them engaged in what you're doing is make them an owner. I know we're sort of teasing about like, think like an owner, you're an owner of the company. And that can be hollow
Well,
And for the right people, that makes sense. Not the people that turned our equity down, of course, but the people who did take it and kept it. That's likely meaningful to them.
well, and it was even those that took it, even those that were excited about it and somewhat understood what the value of it was and what the opportunity was, didn't necessarily show up as owner. At least not how we had defined what owner.
Yeah, good point.
Looking like an owner
Good
would
point.
be. So I wonder if we should just talk about what do these equity grants typically look like? How are they, usually structured? So what's pretty common, what I would say is market, is your equity grant is going to vest over 4 years.
Mm-hmm.
The first year, it's called a 1-year cliff. So none of it invests until you've been there at least 12 months.
And why is that? It's obviously because I gave you a whole bunch of equity. I don't want you walking out the door and I'm like, sweet.
And have
equity.
something, right. And
It's to
so
cover your
you got to
ass.
be here for a little bit, drive some value, create something that's, increasing the value of the organization. So first year, you don't get anything vest, but then at that 12-month mark, 25% of it lump sum vests. And then every month thereafter, 1/48 of it will vest the 40, right? So that's typical. Now you can see it a little bit different, but I would say 95%, if not more, equity grants are looking like that. So you're buying in for a long period of time is part of my point. Get one of these equity grants. And there could be an exit. You could sell before those 4 years are up.
Yeah.
So now that vesting still, rarely will the board accelerate your vesting to the close. In fact, a lot of times the buyers will will tell you not to do that. So oftentimes you're still vesting with the new buyer being the new boss. And so there's a long commitment to for a lot of them.
Not trying to be combative here. My experience around the acceleration at close
Say more.
has been the opposite of that. I think that's a feature, not a bug, meaning if you are bought out, if I was promised 0.1% of the company and I've only gotten 0.005% of it or half of it, if there's a deal that happens before that, it does get accelerated. Like, hey, you stuck around. We thought it'd be longer, but hey, it's fully diluted. We have this. We let it happen. I've not been involved. Our last one was like that. They accelerated. All the ones I've been a part of have accelerated. I slightly disagree. We'll see what we'll do with editing with all that. But
well, fuck you.
because I actually think that's part of the perk of employee. Or you're right.
So the reason you would not do that is the new buyer has the same interest in keeping those employees on to create and deliver value. And so I don't want people that lose that interest or have that motivator at close, because now I'm inheriting this risk of them walking.
Yeah, I see it. Yeah, I see it. I know I think I know the reasons, not all of them, but I know the reasons behind why they do it. And it might even depend on what, maybe I'll cheerfully take back some of that and say, it depends on where you're at. If you're a founder, if you're early,
That's true.
versus some of the.
Well, it depends on who the buyer is too, right? They may want, hey, fuck you. We want you all to leave.
Yeah.
So
Here's
your money. There's the door.
Yeah. What has been some of the reactions around when payday does come? Accelerated, not accelerated. What are some of the reactions like, hey, where's the rest of my money?
Yeah. Well, so, the number one question I would get as a CFO in a startup that's pushing out equity to employees, you'd give someone, okay, here, what's our name of the person today? Our idiot
Timmy.
employee. Timmy, the stupid employee. Here, Timmy is 1,000 units,
Valued
1,000
member
shares.
of the family.
Yeah, value. That's what I meant.
Valued
What did
member
I
of
say?
the family.
Valued member of the team.
Yeah.
Here's 1,000 units, 1,000 shares in the organization. Thanks, Josh. What's that worth? How many shares are there total? What percent of the company
Very
do I
curious.
have?
Why his friends call him Whiskers.
Yeah, he's very curious. And like, okay, well, yeah, there's 10 million units outstanding, so your 1,000 is maybe not as great as it sounded. You have 0.001% of the company, and it's worth $15 a share. That's $15,000. Okay, when do I get my money? When do I get that $15,000? Well, funny thing.
That's the thing.
That's the thing. It's really worth that yet. It's what's worth on paper. And we got to create value and we got to sell the company.
Might be worth more.
Might be
Or
worth
less.
more. Yeah. And so explaining all of that, and once then to my point of, hey, these are typically not, winning the lottery, life-changing type windfalls of cash. When people start to realize that, I think that's where our experience has been.
Yeah.
When people don't show up as owners like we thought. Like, well, it's 15 grand. I don't even know if I'll ever get it. It's 4 years out from now. People are so immediate. I need, instant gratification that it's difficult for some people that get that equity later in the cycle to really appreciate it and have it be a motivator.
Yeah, we're talking right now about some of our personal experience, which is real and valid. And I don't want it to come across like we're anti-giving, because I think we both are pro. Give employees equity. It helps them buy in more, period.
It does.
This is the reality of what happens. And where I get kind of stuck in my craw is when people do like, well, Mike, you were the founder. Why do you get so much equity? I don't know, because I fucking founded the company.
Yeah.
It was all mine at one point.
Yeah.
And so people love to play the victim later on, like, oh my God, you made millions of dollars. I made 25,000. Yeah.
Mm-hmm.
If you want to make more, go start your own fucking company.
Yeah.
You take all the risk. You go do the thing.
You put your money into this.
And then give me 10% for showing up 2 fucking years later after it's been safe and secure and we're profitable.
Yeah.
You want to do that deal? Because I'll take you up on it. And likely you're going to tell me to pound sand. Likely. So I'm advocating for it's a great benefit, and you should do it as a CEO, as a management team, as a board, early stage, do it. And if you receive it, say yes, please, and thank you.
Mm-hmm.
Don't fucking bitch about it. If you want more, do more. Be more valuable. Start your own thing. Don't come bitching after the fact like, I can't believe you made so much more than I did, because that will get me upset. It'll get me angry.
It feels very targeted at maybe the person you're looking at, Mike.
It may have happened to me more than once. I had a great advice way back in the day, and I don't want to use his name because I don't know if he wants to, but back at Livio, it was in healthcare, Livio Health Group, and one of my board members, he was an investor. He said, Mike, it doesn't matter how much you sell this thing for, you're going to get shit from everybody. You're going to get shit from your investors. You couldn't sell it for more. True story. Somebody did actually say it. You didn't think to negotiate for more? I'm like, that's a great idea, dumbass. Yeah, I tried to negotiate more. I was negotiating against a $12 billion gorilla. They had a little more leverage. But we got it. Again, this isn't a good exit.
Yeah.
So you complain about it. There are people who, in I'll call it friend group or my sphere of influence, I can't believe you profited that much off of healthcare. Weren't you trying to serve like the poor and the homeless and the destitute and,
How dare you?
How dare you profit off of their suffering? Oh my God, people, we help them.
Mm-hmm.
We saved lives. So you get it from them internally. Got the same thing. I can't believe you're getting this much more than I am. You were hired last week, dude. What the fuck you talking about? And so he was
The
right.
fact that you're getting anything is...
Yeah. His name was Mark. I'll just leave it at that. Mark was dead right. Like, doesn't matter what you're going to do. Everyone's going to fucking hate what you did.
Mm-hmm.
As funny as that sounds. And so when you're giving out equity, and I'm sort of off track here, but when you're giving out employee equity, not only your employee's going to give you shit about the final math of it, so is everybody else.
That's true in
But
life.
still
right?
do
I mean,
it. Yeah.
As a leader, you're always going to be...
We're both married. Yeah. They get you coming or gone.
No comment?
My wife's the best.
Not sure what's going on in your
My
house,
wife is
Mike?
the best. Unlike what you say about your wife.
Oh,
My wife is
God.
fantastic. Sarah, thank you for putting up with me.
Let's
Light
cut
of my life.
this. Let's cut this.
Best. No, keep this in.
Do you see so we've talked a lot about why we should give equity. Have you seen founders go the other direction and give too much or carving out too much of the pie too early?
Yeah, not often. And here's where I found I saw it I'm thinking of 2 different companies, and both were CEOs with one definitely had imposter syndrome. The other one was just
The founder did?
The founder was, yeah.
Okay.
And the other one was just unsure of himself. And in both cases, there was a key employee they wanted to bring in at not a founding stage, the later stages when there was, a good inflection point. And they're like, I'm going to pay him as much as I am, and I'm going to give him 10% of the company. I'm like, whoa, 10%? For what? coming out of your equity? No, they're going to come in and they're going to solve this big, huge problem. They're our savior. We know what that's like. They're the savior. Once I hire this person, it's all going to come together. So I've seen it happen twice. And in both cases,
I've seen this episode before.
Yeah, both cases, the CEO was just not sure of if they could deliver more value. And so that, well, if I just give up this fake equity, it's not real dollars, this will solve all the problems. We're all going to get rich. It's going to be a multiplier. And sometimes that's true, but to your question, the only time I've ever seen it, it's always been from a position, what I would say, of a weak position of weakness. Like the CEO wasn't super confident and he was chasing, you're chasing the pretty girl at the dance. So you're going to throw out anything. Here's 10%, here's 20%. You can be the CEO. Seen that too. And that's silly. There's no reason to do that. You can be convinced someone's going to be your savior. Turns out they're just blowing smoke like everybody else is. They might be valuable. They're not the savior.
I would say at no point outside of the founder group, at no point is a single employee worth double-digit equity, even early on. I don't know a scenario. If you're early on and you need to bring someone in for 10%, why the fuck aren't they part of the founding group? Why weren't they a co-founder? Valid question.
Yeah.
And if it's later in the cycle and you're trying to get why? There's no way they could be that much value to the organization at that later stage.
Or if they do, like your board should recognize it. Like, okay, because it's not happened for me. But
it would almost have to be part of a significant pivot or shift in the strategy.
Unless they're a rainmaker and they can bring. If you're I'll make up a scenario, which we've tried to do, not we, but in other companies I've been a part of, where I'm a software and I sell into poultry producers, as an example. And here's the big stud poultry producer sales guy who knows all of them. He's not good to us anywhere, but he can bring immediately. We're doing $2 million in revenue. This guy's contract can bring us 20. As a board member, I would entertain that. I've seen something similar, not a poultry producer, but I would, if upon almost make it a milestone or contingent, if hit, I'm prepared to accelerate something. But even the equity, pay him cash, pay her cash. Well, you don't always need to be equity. It'd have to be that scenario, and everybody would have to be stacking hands and seeing aligned, same paged on their value of what they're bringing to the company. Because early on, if you're not a very sophisticated, very, not far along the path as a startup, I'm talking sub $3 million in revenue, you can have a magician fall out of the sky and make you a $30 million company because of one person with the right connections. Not likely, but they're out there.
I'll agree with you that's probability of that would have to.
Every CEO thinks that they've found that one person and it happens. Yeah. Well, see, I'm a sales guy, so I believe in our superpowers to change the trajectory of a lot of companies.
I'm an accountant and live in the world of reality. So
next episode, sales versus ops.
Sales versus ops.
We're going to close $1 trillion next quarter. My pipeline has us with 50 trillion, so it's a conservative estimate. As one example.
I'm looking at your Salesforce pipeline. I don't see $50 trillion in opportunities.
Well, lots happened. Jimmy went on vacation. Jimmy's on vacation.
We should also do an episode of where we speak in only corporate lingo.
Sounds like a skit.
That sounds like. Let's talk about some scenarios where how much is the right equity. So it's a small founder group. You're probably first, maybe second, maybe third actual W-2 hire. And it's a technical skill set, whether that's like a coder, an engineer of some kind, but it is a skill set that is directly linked to your product or service. Without that skill set, you can't build, you can't deliver what your company does, right? So critical role, one of the first roles, what's the quote right equity percentage?
Well, I'll go back to something you said.
Because there are some formulas out there and some guidelines. I'm
Yeah.
curious how you think about
So
it
I
as
think
a
of-
founder.
So it's scenarios, so I can't have all the perfect information. So it's definitely less than 10. I'd even say it's less than 5. It's less than 5%. If they're, again, non-founder, but employees 1, 2, or 3, I think is what your scenario suggested. Am I supposed to pay attention to that when you're qualifying the question? The details of it?
Some people would.
So
it's up to you.
in that scenario,
Optional.
I think those kinds of people warrant significant. To me, significant is something less than 5, but north of 1.
Interesting. This is probably not a shock to you. I would be more conservative.
Not a shock. Would you ask for their firstborn and a pint of blood
Yeah.
for that kind of equity stake? What would you give? What's your range?
So first hire, technical skill set. I would be more kind of systematic around it. So, start with say 3/4 of a point and, add from there based off of it. I would say somewhere between 1 and 1.5 for that first hire that's bringing a critical skill set, technical skill set. That would be probably 1 to 1.5. Because at the end of the day, as you build out the company, this is not going to be a leader. They may be a strong,
right.
likely. They'll likely be a strong individual contributor. They're going to be one of many in that role as you grow. This is just the first one. So this is where you're rewarding, in part, the skill set that they're. What you're really rewarding is them taking that risk of jumping into a startup.
And I can't fuck this up. Remember, if I'm bringing you in, I can't wait 3 months and you dip out and say, like, you know what, my change of heart, want to leave. I need you locked into the chair.
Yeah.
And one thing I think we're leaving out, which is really important, we should talk to it, is not just don't think about the one employee. You're boarding you, or you should be thinking about what's my pool of shares that I want to put out there, right?
Yeah.
There's some standard 10%, 15, 20%. 20% is high, but you're likely, especially when you start getting professional money, they're going to want to see a pool of equity that is dilutive, and
likely to
is
you
no
and
cash.
not to them as the professional money coming
as
in.
it turns out.
Yeah.
But we've also shared dilution with some at times with folks, or did it.
Yeah.
And they like us, the professional money, the VCs, want to see a bought in senior team, key members, and especially early, because it's so critical those early days, so you'd give it up. So if you're talking a pool of, let's say, 10%, which would be pretty common, with or without professional money, I'm going to set aside 10% of all equity, fully diluted, for employees that are not going to give us any money. It's going to be considered like an incentive package. I think that's a good way to work from. In your scenario now, if it's 10%, I can get behind the 1.5%, 1 to 1.5%.
Yeah, but then you have 8.5% left.
Revising my answer.
Then you have 8.5% left for
others,
hires 2 through X. And so that 10% number, I agree with you, is pretty common. Then once you start getting into round 2, round 3 of professional money, a lot of times those firms are going to want to see you refresh that equity pool and get it back to 10% again. And so be dilutive once again. And so as you look across the life cycle of all of these liquidity events or equity events, it probably is about 20% of your equity from day one is going to go to employees if you go through that whole growth journey with multiple iterations of financing. Yeah.
Well, and I think, and it's not just, and if you're of value, if you're an employee of value and you're adding to the, contributing all of the time, you might get 1.5% this round, you might get 0.5% the next round, might even get, depending on where you're at, you might be taking a bite of that apple every time around.
Yeah.
You also may not. Just because you got to get it this time doesn't mean you're going to get it next time.
And you're going to participate in the dilution every time that happens. So your 1.5% from being the first employee is likely, 0.0 something percent by the time you exit.
That's right. And again, dilution is, want to try to dispel a myth, if I may. Ghosts aren't real. And when you have dilution, that's not always a bad thing. Because what likely just happened is you either have somebody bought back in to do something amazing, or you just receive growth capital to go burn it down. So don't think dilution is always bad. Be looking at your value of your units, your shares, your whatever, what is it worth? You had the example of it's worth $15,000. Well, if I dilute down, but now my units are worth 30,000, they just doubled. That's a good fact pattern.
You still have 1,000 units.
Still have 1,000 units. It's worth just now worth twice.
Yeah.
You own less of the company, but your stake. And then next thing you know, like, oh, we become $1 billion unicorn. Now you're $30,000 and you're like 0.00001, whatever it is. Now it's worth $3 million. You cool with that, or are you bitching about your decimal
Percentage?
spot?
Yeah.
And so when we talk about this, like you're going to get diluted down, you get diluted down. That's true. The flip side is, I've got likely $5 million, $10 million, $25 million of go juice. Let's go hire 1,000 go juice, right? Let's go burn it down with 15 sales guys or a new growth initiative, whatever it is for your business. And that's likely gonna skyrocket your company, or it ought to. That's the trade-off. I don't want to own more of the company. I want my ownership of the company to go up, or the value of it to go up. That's what I want. Unless you're 50.1% of owner in a company, your percentage doesn't fucking matter. What matters is how high is your stack. If I line up all my dollar bills, did it go up or did it go down? And so if you're worried about your percentage, it's always going to go down. It's never going to go up, likely, right? It's always going down.
I've never seen it go back up.
It never goes back up. So watch the stack of your $100 bills on your table. Is it going up or is it going down? That's what you worry about. That's the only thing you should be worried about. And that's why you do employee incentive units like that, is because everybody's aligned on making the company more valuable. In fact, you got a stack on your table. What's your stack? Is that helpful? Was that terrible?
That was better.
Maybe not all the way there.
That's it for this round of Burn Rate and Bullshit.
Where the only thing we sugarcoat is our coffee.
If you liked what you heard, great. If you didn't, even better. We're not here to make friends.
Hit subscribe, share with someone who needs a reality check. And remember, hype dies and execution wins. Stop pitching, start proving.
Send lawyers, guns, and money. The shit has hit the fan.